Alrighty traders, John Howell here. Let's get into a bit of a market update for this week. Let's get straight into it. Don't place a trade based on what you'll see in this video because there is no guarantees of making a profit in the market. It takes you a long time to become a good trader. So this video here is just to educate you to become a much better trader. Alrighty traders, let's get straight into it. If you do need help with your trading, if you're struggling, then I'm running a sale, $7 for my trading course. Go get it right now, guys. Happy Valentine's Day to all the beautiful ladies out there as well too. Let's get straight into. Let's actually look at the actual market itself. So let's have a look at this here on a short-term technical analysis. But I want to give you guys some analysis of what I think it was happening overall as well too. The very first thing is this: is that you have to think about the markets as if everyone is seeing the same thing, it's probably not going to work out. If you're hearing videos saying, oh my goodness, here we go. There's a big, massive head and shoulder formation, and it's going to break the neckline. And if we project from there to there, and it's going to go, you know what I'm saying, right? So if you hear a lot of people say that, this is the head and shoulders, this is the projection on the headline, then the opposite is more of a probability in the market. The market is funny that way. If everyone says the same thing, like for example, I did a video a while ago, and on one of the videos, there was actually a lot of comments that actually said, no, duh, John, everyone know the S&P 500 is going to 5,500. Now it's actually at 4,500, right? That's 1,000 points up. Everyone has actually had a lot, well, no, duh, John, everyone knows it's going there. And when that came out, guess what's happened to the markets ever since? The market's pulled back. So just be careful of that, guys. And that's why I love doing YouTube videos. I really do, because I love to see the barometer of what most people are thinking in the markets, because it gives me, obviously I do my analysis as well too when looking at the fear and greed index, and I look at the other markets. But it's good to see where most people are at. With the overall markets here. So the thing is that we can see that this is a head and shoulder formation. Now, one of the things that you'll notice with head and shoulder formations is that a lot of the times head and shoulder formations, they don't really work out nowhere near as good as they used to back in the textbook days. Right? Textbook days is back in the 80s, all right? You know, here's a head and shoulder formation, it breaks down. Yeah, that may happen. And I guarantee there's a lot of people thinking about this head and shoulder formation right now. That on a short-term level, yeah, we are getting a lower high, we're breaking down. So there's a high probability we're going to come down and maybe test a double bottom and maybe in a flush a new low. That's what the market's probably going to do. Why? Because it's going to get a lot of those bumblebees out there going, oh my goodness, here we go. It's on. The market crash is going to come in. And then those people who have been calling crash for 20 years is going to say, I told you I was right. But don't be fooled, guys. Don't be fooled by this. Yes, we're probably going to get some sell-off. And yes, you know what the market's going to do? The market says, okay. And it sounds really weird, right? Because it's like the market, right? The market knows. And it's really weird. It's like, who is the market? It's like it's always fascinating, right? It's like the market knows. But here's what the market knows. The market knows, one, that a lot of people are saying, oh, shoulder, oh, there's a big head, oh, there's a shoulder formation, big rounding top, oh, the market's going to crash. Here we go, okay? The market knows that, one. So the market also knows that, okay, well, if you break the neckline, you project that down, therefore the market's going to go down to all the way down the bottom here, and it's going to be all over, right? So the market knows that. So if the market does start to pull back even more, which I'm actually expecting, it's going to get a lot worse, I believe. This was probably likely to happen, right? We're probably going to flush down, maybe even flush down a little bit through here. And then all through here, it's going to be a breaking of a major support level. And you're going to get so many people coming out of the woodworks. You're going to get the fear and greed index flying off its little titter. Right, we're going to get this little fear and greed index right here, where it's at fear right now. Could you imagine where if that did happen, we got more downside, and a breaking of this low through here. Can you imagine what's going to happen? Like where this fear and greed index is going to be pegging its little titter off right here near the extreme fear. But guess what? When are the best times to buy stocks? Let me ask you a question. Like, let's actually take the emotional thing out, right? Let's take what you hope is going to happen, maybe because you've got put options in the markets right now, or let's take out what you think is going to happen based off headlines and based off fundamentals. And just remember, guys, the big problem with trading fundamentals is that you're trading what's already happened, not what's happening or going to happen. Makes sense? That's always like, oh, really good earnings, really good report, everything looks really good, and the market tanks. That's what's happened with Tesla this last couple of months. Tesla's come out with incredible earnings, right? Look at good old Tesla here. Where is Tesla? Here. Right? Look at Tesla. Tesla's come out with some incredible earnings. But guess what's happened? We've come back down. Huh? That doesn't make sense. We should be going to the moon. So this sort of fear and greed index, when we start to peg down through here, we're probably going to be down, maybe more. We're probably going to be, again, let's go back to the S&P 500 here for a minute. Okay, we're probably going to be breaking this low here. But this is what's probably going to happen. We're probably going to break this low through here. And it's going to be probably a bit of a false breakout. We're going to do something like this. We're going to flush down through here somewhere. And then what's probably going to happen is we're going to be probably down. How much would that be? How much would that be if we got down through to here? Yeah, we're probably getting down to 15, 16%. We may even get down to this level through here somewhere. But I don't see this thing heading all the way back down to these ultimate lows down here. I don't see this being the top. No. What I do see is this being a little bit of a bumblebee sucker, right? And especially right now, where we're getting a lot of the put buying right now is at an all-time high. And so if we do get more downside, this is probably going to be very, very, very close to a bottom, where once again, we're probably going to break this low through here. So many people, one, are going to get stopped out. So many people, too, are going to be buying put options because they're going to see their head and shoulder. And then the market's going to do this. And then it's going to reverse up and then suddenly shoot up like that. And you're saying, oh, you little fucker. Oh, the market's rigged. Oh, the market's against me. Oh, my goodness. And all this sort of stuff's going to come out of what you think of what's going to happen in the markets, right? So we're probably going to get that bit of a slingshot pattern happening. That's what I'm expecting, because when traders, if you think about where we are right now in the cycle of things, we're nowhere near towards the end of the cycles, okay? Remember, cycles, most of the time, cycles end after the Fed has been raising rates for quite some time. The very first interest rate rise doesn't cause the market to prick. Let me show you. Okay, so let's go have a look at this maximum chart here, okay? So this is what actually happens in the actual real world, and this is what you have to think about this, okay? So when the market's rising up, the market goes up and up and up and up. It may pause for a little bit, go sideways, but big, massive crashes, nah. So look at this here. Right, back in 2000 into 2007, look what happened. The rates started what? Slowly going up, going up, going up, going up, going up. And then guess what happened? Recession in 08, right? Into 09. Oh. Guess what happened here? We started going up and up and up and up and up and up and it started flattening out when? Around the 2000, this was 2000 in 2017, 2018, they kept pause. And then guess what happened? Then the market dropped. So then guess what's going to happen now? They may raise it once, twice, 3, 4 times through here. And then guess what? Now, okay, we're getting towards the top of the market. Do you see what I'm saying there? So generally speaking, they raise them a little bit, and it pricks it, right? Every time we go through a pullback, and they start to raise interest rates, that's when, so the interest rates in the markets haven't even started raising once, okay? So it takes probably around a consecutive of raising rates throughout maybe 12 months to start to really prick the bubble in the markets. Yes, we get some adjusting, and yes, we get some pullbacks and corrections in the markets, but it is not the top in the markets. It's just a bit of a correction in the markets. And so if you have a look at this here, check this out. This is a This is a thing that I saw just recently. And it's when is the best time to buy the stock, right? When is the best time to buy stocks? There's actually two best times, based off the Fear and Greed Index and also based off the VIX, right? So you know the VIX. So with the VIX, if the VIX is starting to, if the VIX, as you can see here, if the VIX starts to get over 30, 35, 35, and if we start to get into 35 to 40, if we get above 30, anything above 30, 35, 40, even 45 to 50, like if we start to get a VIX spiking above like 45 to 50, and you just bought stocks and you held them for a year and a half, because this is looking at the sector's 500-day trading since 1998. What happens in the markets when the VIX spikes up this much here, like 45? Like what actually happens? Now, I think this is really important because I believe we're going to get that in the next big downturn, right? We're going to get the big massive downturn. And those who are prepared when that happens, maybe 12 months, 2 years down the road when that actually happens, there's going to be incredible buying opportunities for most people out there that are going to make so much money because of what is going on there, right? So if you start to get the VIX spiking above there, and you had like a lot of money on the sidelines or a lot of money getting ready to trade the markets, and you started riding the hell out of put options because you're wanted to buy stocks or buy the markets, it's probably going to be an amazing time. But you can see here, this is 500 days after. So about a year and a half later, right? So you can see here that if the VIX was at 25 to 30, you still had some pretty good gains. But when the VIX starts to get to 30 to 35 level, you start to have all these literally 40%, 30%, et cetera, et cetera, et cetera, et cetera, et cetera. Right? Then we start to have a look at that through there. So you can see where the VIX is right now, and the VIX actually spiked up to 30 yesterday and then came back down, or on Friday, and then came back down. We actually got above 30 through here on that last dip, and we got above 30 here on that last dip, right? So this is above 30, above 30. Remember traders, this is what happens 500 days later. If we get a spike here in February, then that tells you, this spike in February that actually happened, right? This spike in February that actually happened back here. Generally speaking, 500 days later, you're probably likely to be doing really, really, really well out of the markets. But the big thing is just keep an eye on that Fear and Greed Index, because as you can see, that I've talked about this a few times, if the Fear and Greed Index starts to get down into maximum fear, well, you know you're in sue for some incredible moves. Okay, so as the market keeps following through, and as the market keeps doing its thing this year and next year and so on and so forth, hopefully you are around, because the statistics show that 90% of all traders are going to blow their account up in 90 days. It's called 90-90, the 90-90 rule. 90% of you guys right now are going to blow your account up in 90 days. That's just the statistics in the markets there. So, and so that's what I'm seeing through there, traders. And I know a lot of you are going to say, but John, what about, the war, and what about the takeover, and what about this, and what about that? Well, let me ask you a question. Have you actually gone back in time and saw what actually happens during war times? Like, have you actually gone back in time and because a lot of people would think, right, that's really bad for the markets. We're going to war. War is going to create war is going to create the market crash. Is it really? Is it really going to do that? Because if you go and have a look, and I've actually looked at the last big major wars that we've had, back in, I think it was 2003 and so on and so forth. Your thoughts is, okay, if we go to war, or if there's going to be a takeover, or there's going to be all this sort of stuff, overseas, then that's going to cause the market to crash. The market's going to have so much fear and so uncertainty. But once again, traders, is that actually true? What actually happens in the past that is? And you'll find so many times, you'll find that actually, let me see if I can. So when we're talking about the war, okay, and we're talking about this here, this is actually a chart that I saw from I think it was called The Path, from Tony Robbins, and he's one of his partners here. But look at this here. I want to just look at this here. If we go through all of these datas here, right? All these datas that actually happen in the markets, and and we look at, when wars happen and so on and so forth, you can see, look at this here. So the Spanish-American War started when? Roughly around this time here, right? It's not an exact, right? But at that time there. If we go to the Korean War, right? This is the Korean War here. When was that? Oh, that was actually at the bottom of another move up. Oh, Berlin. The Berlin Wall. All right, so then we've got the Cold War. We've got the Vietnamese War. Actually, the market continued up from there. Look at this here. So we have the Gulf War in 1991. When was that? Oh, it was actually at the bottom of that there. We also had the 2003 war in Iraq. Oh, we all know 2003 was the bottom on the stock market, right? So if you can see that overall, now not one day, right, but overall, you look at these majority of wars that we've had, okay, back since 1898, and the really funny thing is this, is that what people think and the truth, and this is where it's important to stress test your thinking, because your thinking may be wrong. It's going to cause you to lose a lot of money. Stress test your thinking. See, I always thought that. I always thought, okay, well, surely that if Russia or China takeovers and wars and all that sort of stuff, right? Surely that's going to cause a lot of havoc in the markets. It may do on the short term, right? But overall, if we're looking at, if we look at the overall picture, if you look at back in time, you can see that wars are actually bullish for the market. That doesn't make sense, right? It's like, hang on, this does not make sense. Again, the market the market works in opposites. So always stress test your thinking when it comes to the market, because one, it can save you a lot of money, but two, it can make you a lot of money because now you see the truth for what it really is. Oh, the market's been pulling back. And do you know, majority of the wars in the markets happen after we've had a downturn, right? That's because, when the market has a downturn or a pullback, it's after that time, right, that we start to go through. Like if I just zoom in on this one right here, right? If we just zoom into, right, let me just zoom right in here, right? Look at this here, Korean War as an example. Look what happened, right? It was after the market was having a bit of a short-term pullback that, guess what? We actually found the Korean War started and the way we went, right? If we have a look at the one of the big wars that we know, which is the war in Iraq. This is the war, right? This is the war in Iraq. Look what actually happened. It was after the market was actually in a downturn for a while. So I don't believe we're getting ready for war soon because the market hasn't been pulling back for a while. So just look at all these pull back. Now this is obviously squeezed up. So this is obviously many years, right? This is obviously a couple of years worth of data here. And then guess what? We went to war and then the market took off. It's like, interesting, right? So there's two interesting things about wars in the markets. Firstly, I've noticed that it's after we have a significant downturn in the markets, then that creates war. Thirdly, or secondly, that's firstly. Secondly, is that when there's a war announced, go back and do your studies, you will notice that wars is actually a good thing for the markets. Why is that? Well, you can get into a lot of reasons why, so on and so forth. But just always stress test the way that you are thinking about these markets traders and the big picture through here. So with all that being said, with what I said through here, that's the reason why when looking at the stock market and looking at this here, we're probably going to go back to what we're looking at here on a short-term basis now. The market knows that everyone's looking at this head and shoulder. The market knows that, yes, we're going to we may even flush down and break a new low here, and then we're going to probably come rallying right back up, and then we're probably going to see an incredible move to the upside. So traders, when I first started trading, I lost $250,000 trading the markets. And then I got access to a few seven-figure mentors that really set me straight on what I need to do with the foundations, how to read the charts, the trading systems, the mindset, so on and so forth. And then that was the massive turning point for me to be doing really well from actual trading and being successful trading. So what I've done is I've created a course called the Breakthrough Course. And what I've done is I've actually put a whole bunch of really good education and strategies and processes that helped me go from $250,000 in debt to then actually becoming a full-time trader, making a full-time income from trading. And I'm actually running a flash sale to that trading course. So if you go to johnsflashsale.com, or there should be a link in the description. If there's not, then go to johnsflashsale.com. That's JOHNS flashsale.com. Go to johnsflashsale.com and you'll be able to get access to this course now for $7. So go get access to that right now, guys, and I'll see you real soon.